Joining us live now is senior reporter from the Australian Financial Review, John Kehoe. John, thank you for your time. It's been a big discussion around Canberra lately, has been whether the government will, the Reserve Bank rather, will look into buying any kind of government bonds known as quantitative easing. It's an emergency measure by the government to stimulate the economy, by the Reserve Bank as well. Do you think that this has widespread support?
Well, there's a big debate now unfolding amongst economists whether the central bank will go down this path maybe next year after it maybe cuts interest rates once more to 0.5%. Not only whether they'll do it, Annalise, but whether they should do it. And, you know, there's a divided view. Warwick McKibben today, I've reported him saying basically the RBA shouldn't go down this path because it'll distort capital allocation across the economy, keep alive zombie firms, makes pricing risk too difficult. He's dead against it, former RBA board member, top economist in Australia. On the other hand, Phil Lowe, who, let's be honest, probably doesn't want to go down this path, but he's contemplating it. He released a report on Tuesday from the Bank of International Settlements, a committee that he chaired, suggesting that these sort of crisis-era tools like negative interest rates and buying government bonds that other central banks have used since the financial crisis 10 or so years ago have been relatively effective, although there has been some side effects.
Is the implication from what he's saying that the Reserve Bank would be forced to do that because the government's not stepping in with stimulus?
Yeah, essentially. I mean, Phil Lowe's preference, there's no doubt, would be for the government to do more fiscal support for the economy, as he's been banging on about for a while, like infrastructure spending, maybe accelerating a few more tax cuts, as Labor's been on about, actually. So there's no doubt he'd rather fiscal policy step in before he has to use these unconventional monetary policy measures. Look, it's not assured that he will use these measures. It's just becoming more plausible as the cash rate falls towards the sort of lower bound, which is estimated by most economists to be only one rate cut away at 0.5%. So you'll continue to see these sort of tensions between whether fiscal or monetary policy should be doing more to support the economy over the coming months beyond the government's existing infrastructure spending and tax cuts that are already baked in.
The thing is, when he argues that it would undermine capitalism, I guess the tenet of capitalism he's talking about here is companies failing, and that would have huge ramifications for the economy. Yeah,
so Warwick McKibben, he points to the evidence in Europe that these ultra-low and in some cases negative interest rates are keeping alive these zombie firms, so stopping them going out of business, which at one level you might think's good. You know, they're getting this cheap cash, they don't have to repay much on their loans. But, you know, the creative destruction of capitalism that we've been accustomed to for many decades, you're meant to have firms going under to make way for new, more productive firms. And he thinks, and some economists think in Europe, that's not happening enough because these old zombie firms are being kept alive by cheap money and preventing the sort of reallocation of resources across the economy going to these new productive startups that generally do boost productivity across the economy. So yeah, it's a very interesting debate unfolding.
The thing is, the Labor argument has been that the government's holding back on the stimulus because they're just trying to protect the surplus, and that's become a real political thing for them. But from the government's perspective, a surplus is one of the best indicators we do have of a strong economy.
Yeah, look, I mean, the government has some foundations to the idea that delivering a budget surplus does send a strong message to international investors, maybe to businesses and confidence generally across the economy that the government's got its books in order. I think that's a reasonable proposition. At the same time, I don't think you can just be going for the surplus at any cost, and nor do I think Morrison and Frydenberg ultimately will. I think if there is a very strong case or becomes a stronger case that the fiscal purse strings need to be loosened, I get the impression they'd be prepared to consider that maybe after this year's MYEFO, or certainly in the budget next year, maybe even beyond these sort of business investment allowances. But at the moment, I think they're hoping that their existing policies have got enough. But, I mean, the evidence now is that probably another arm of policy, fiscal policy, may have to do more.
And just in the meantime, it really just plays into Labor's hands that they do get to have this kind of ongoing criticism about the economy, even though a lot of the figures are doing quite well.
Yeah, it's interesting. I mean, Labor's sort of saying you don't have to blow the surplus, but you can spend a bit more money on New Start or infrastructure spending. So they're sort of having their cake and eat it too at the same time. I mean, sort of treading between going down a budget deficit path, which Labor doesn't want to be associated with, and on the other hand, not giving enough support to the economy, which they're criticising the coalition for too. So it's a delicate balancing act for Labor as well, but they can sort of sit on the sidelines and not have to have the responsibility of ultimately managing the budget. But I mean, I would point out that they are probably more in sync with where the RBA's at the moment in terms of wanting the government to do a bit more on the spending front as well. So I think Labor's position is closer to the RBA, what they'd want. At the same time, the coalition at the moment is still going to hold the line.